Means of procuring better security outcomes and burden sharing. In Besant's words, a more clearly segmenting the international economy into zones based on common security and economic systems would help highlight the persistence of imbalances and introduce more friction points to deal with them. Countries that want to be inside the defense umbrella must also be inside the fair trade umbrella. Such a tool can be used to pressure other nations to join our tariffs against China, creating a multilateral approach toward tariffs. Forced to choose between facing a tariff on their exports to the American consumer or applying tariffs to their imports from China, which will they choose? It depends on the relative tariff rates and how significant each is to their economies and security. The attempt to create a global tariff wall around China would increase their pressure on China to reform its economic system, at the risk of significantly more global volatility as supply chains come under greater pressure to adjust. From America's perspective, if other nations choose to keep their current policies vis China but accept the higher US tariff, that's not terrible, because then, in this framework, at least they're paying revenue to Treasury and limiting the security obligations of the United States. Joining a tariff wall with a security umbrella is a high-risk strategy, but if it works, it is also high reward. 23. A user's guide to restructuring the global trading system. Tariffs and competitiveness. Government revenue must come from somewhere, and requires some form of taxation. The characteristics of the tax code will affect overall economic growth and international competitiveness. Many in the Trump camp see them as joined. The relative cost of producing goods for export, or importing from elsewhere, can be affected by whether a nation taxes labor, consumption, capital, or trade. This argument was given explicitly for the Tax Cuts and Jobs Act in Council of Economic Advisers, 2018. Fiscal devaluations. The literature on so-called fiscal devaluations fleshes out this idea. For instance, Fari, Gopinath, and Atskoki, 2013. Show that the economic effects of devaluation in the exchange rate can be perfectly replicated either by two combinations of policies, either an import tariff and an export subsidy, or a consumption tax increase and payroll tax cut. These combinations discourage domestic use of goods and services and encourage domestic production, and result in identical economic outcomes to currency devaluations. Tax policies and currencies are two avenues for achieving a boost to competitiveness, and this equivalency helps build the intuition for currency tariff. Note that what is not the same in each of these policy mixes is the net amount of revenue raised. Because of the emphasis on competitiveness, it is unlikely that a second Trump administration will support an increase in domestic tax rates, whether corporate or income. Its goal will be, in large part, to make America a more attractive place to invest and higher than other countries, particularly China, and higher domestic tax rates undermine that goal. Indeed, the Tax Cuts and Jobs Act of 2017 reduced in the United States statutory corporate rate from the second highest in the OECD in 2016, after Colombia, to the average, 21.2% in 2021-12. Work by Chodorow Rai, Smith, Zadar, and Zwick, 2024, estimated that the domestic investment of firms with mean tax changes increased by 20% relative to a no-change baseline. 13. In that sense, the preservation of low tax rates is a means of generating investment and jobs in America, and even better when financed in part by tariffs on foreign imports. This argument extends to income tax rates as well. As long as labor supply is not perfectly elastic, an income tax will reduce the after-tax wage received by workers and require firms to offset some of the tax with higher wages. An increase in taxes on labor income thereby makes it more expensive to employ workers in the United States relative to employing workers abroad or investing in labor-saving capital. More expensive workers, all else equal, means fewer jobs relative to machines or imports. Distortions and optimal tariff rates. Economists have also spent much time studying how the tax code affects economic decisions, known as distortions. If they take the economy away from a first best, efficiency maximizing equilibrium. The economic distortions are the loss of welfare that occur beyond the revenue raised. For example, suppose a taxpayer reduces her working hours from 45 per week to 40 per week because her income tax rate increased. While she enjoys more leisure, the goods or services she would have produced in those 5 hours, and the salary she would have received, cease to exist and are lost to the economy forever. The deadweight loss or excess burden in this stylized example is there. Lost production, net of the increased leisure she enjoys and revenue raised by the government. Of course, there are many decisions that can get adjusted, not just the number of hours worked, job choice, education. Choice, entrepreneurship, whether compensation is in the form of cash or fringe benefits, location, and much more. These distortions are a function of the marginal tax rate paid, not the average tax rate, since the decision whether 12c https://www.oecd.org/en//about/new//slash-press-releases/statutory-high-statutory-corporate. Tax rates worldwide.html. 13A 20% boost resulting from a 14-point cut in statutory rates might sound small, but that is because the effective marginal rate paid by many firms was well below the statutory rate due to numerous carve-outs and extensive transfer pricing incentives which were, in part, eliminated via TCJA. In that sense, TCJA was a base broadening but rate-reducing reform to the corporate tax code, and their effective reduction in marginal tax rates was much lower than the statutory reduction, on average, 7 points, per Chodorow et al. 24. A User's Guide to Restructuring the Global Trading System. To work those last few hours depends on the marginal and not average rate. And some of these distortions can have enormous consequences over time. For instance, if firm location decision is affected by taxes, agglomeration economies may be strongly inhibited, sharply decreasing innovation and productivity growth over the long term. The distortionary costs of taxation are convex, tax hikes are much more costly when starting from already high rates. A 1-point hike from 35% to 36% marginal tax rates is much more damaging to the economy than a 1-point hike from 2% to 3%. Costs are convex because the higher tax rates move, the more intensely households and firms adjust their behavior to avoid the tax burden. Because marginal rates are already much higher on labor and capital income than they are on imports, the economic consequences of an increase in tariff rates might well be less problematic than an increase in income or corporate rates. For instance, says Slemrod and Geertz, 2012, provide a benchmark for what economists call the marginal excess burden of raising a further $1 of revenue. They calculate that the marginal excess burden is equal to 38% of revenue raised. To understand what this means, go back to the example of labor supply. When the government chooses to extract $1 from the worker's salary, she reduces her work by an additional amount worth a total of 38c, net of the increased leisure she enjoys and revenue collected. By contrast, trade economists argue that for a large economy, imposing a positive tariff level is modestly welfare enhancing, up to a point. Classically, modest tariffs can improve welfare because reduced demand from the tariff imposing country depresses prices of the imported goods. 14, while the tariff produces distortionary welfare losses. Due to reduced imports and more expensive home production, up to a point, those losses are dominated by their gains that result from the lower prices of imports. Once import reduction becomes sufficiently large, the benefits from lower prices of imports cease to outweigh the costs, and the tariff reduces welfare. That tariffs initially increase and then subsequently decrease welfare implies an optimal tariff rate, at which point the country has reaped all possible benefit from tariffs, and a higher tariff rate reduces welfare. For a benchmark, the Handbook of International Economics chapter by Costinot and Rodriguez-Clare, 2014, indicates that the optimal tariff for the United States under plausible parametrizations is around 20%. Indeed, as long as tariffs don't exceed 50%, they still welfare enhancing relative to completely open trade. In other words, increasing effective overall tariffs from currently low levels near 2% will actually boost aggregate welfare in the United States. Once tariffs begin increasing beyond 20%, on a broad, effective basis, they become welfare-reducing. Investment. Houses are now projecting that the projected effective rate of the tariffs proposed by President Trump will jump from 2.3% to 17%, just shy of this 20% level. 15. Moreover, tariffs can address pre-existing distortions due to other nations' trade policies. The list of China's abuses of the international trade system is long and storied, and ranges from state subsidies for export-oriented industries to outright theft of intellectual property and corporate sabotage. These distortions interfere with their discovery of comparative advantage and a free and open system of international trade. Applying corrective tariffs to address these distortions may improve overall efficiency. Where these arguments run into trouble is when other nations begin retaliating against US tariffs, as China did modestly in 2018 to 2019. If the US raises a tariff and other nations passively accept it, then it can be welfare-enhancing. Overall, as in the optimal tariff literature. However, retaliatory tariffs impose additional costs on America and run the risk of tit-for-tat escalations in excess of optimal tariffs that lead to a breakdown in global trade. Retaliatory tariffs by other nations can nullify the welfare benefits of tariffs for the US. Thus, preventing retaliation will be of great importance. Because the United States is a large source of consumer. 14c, for instance, Broder, Lamar and Weinstein, 2008. 15c https://www.wsj.com/economy/trade/Donald-Trump-election-trade-tariffs-AED6C281. 25. A user's guide to restructuring the global trading system. Demand for the world with robust capital markets, it can withstand tit-for-tat escalation more easily than other nations and is likelier to win a game of chicken. Recall that China's economy is dependent on capital controls keeping savings invested in increasingly inefficient allocations of capital to unproductive assets like empty apartment buildings. If tit-for-tat escalation causes increasing pressure on those capital controls for money to leave China, their economy can experience far more severe volatility than the American economy. This natural advantage limits their ability of China to respond to tariff increases. With respect to other nations, if the Trump administration merges national security and trade policy explicitly, it may provide some incentives against retaliation. For instance, it could declare that it views joint defense obligations and the American defense umbrella as less binding or reliable for nations which implement retaliatory tariffs. Additionally, it's not clear whether one should view the failure of this deterrent as a bad outcome. Suppose the US levels tariffs on NATO partners and threatens to weaken its NATO joint defense obligations if it is hit with retaliatory tariffs. If Europe retaliates but dramatically boosts its own defense expenditures and capabilities, alleviating their United States burden for global security and threatening less overextension of our capabilities, it will have accomplished several goals. Europe taking a greater role in its own defense allows the US to concentrate more on China, which is a far greater economic and national security threat to America than Russia is, while generating revenue. What is clear, however, is that given all these considerations, the Trump team will view tariffs as an effective means of raising taxes on foreigners to pay for retaining low tax rates on Americans. The reduced personal income tax rates introduced by the Tax Cuts and Jobs Act are due to expire in 2026, and extending them in full without raising deficits may require raising almost $5 trillion of new revenue or debt over a 10-year budget window. Doubtless, tariffs are a big part of the answer for extending the tax cuts. Revenue must come from somewhere. 26. A user's guide to restructuring the global trading system. Chapter 4. Currencies. Currency policy and risks. In the driven world, the demand for reserve assets causes persistent deviations from the equilibria in currency markets that would balance trade. This disequilibrium in trade occurs because the real exchange rate is too strong. Exchange rate overvaluation can be redressed by tariffs, as discussed above, or by addressing the undervaluation of other nations' currencies, as occasionally floated by President Trump, Vice President-elect J.D. Vance, and former Trump administration officials like Peter Navarro and Robert Lighthizer. Currency policy brings different considerations than tariffs do. The principal risk of pursuing a fairly valued dollar is that the policy intervention makes dollar assets less attractive in the eyes of foreign investors. At the time of writing, the yield on 10-year USD debt is roughly 4.25% per year. Suppose movement towards the currency valuation that would arise in a trade balance equilibrium would result in foreign holders of USDs expecting a 15% reduction in their domestic value of their USD holdings. That represents almost 4 years' worth of interest payments, and over a third of all the expected interest over the life of the note. 3-year USD debt yields 4.1%, implying the devaluation would eat more than all expected interest, i.e. the note holder loses money over the life of the security. These risks can be a disincentive for holding dollar-denominated fixed-income securities. If an expected change in currency values leads to large-scale outflows from the treasury market, at a time of growing fiscal deficits and still present inflation risk, it could cause long yields to rise. Because significant portions of the economy, like housing, are tied to the belly and long end of the yield curve, such a rise could have material adverse consequences. This risk will be somewhat compounded if inflation remains elevated. As discussed in the section on tariffs, their results in Gopinath, 2015, indicate that a 20% depreciation in the dollar would boost CPI inflation by 60 to 100 basis points. A one-time adjustment in the currency without second-round effects should be looked through by the Fed as a price level rather than inflation rate shift. However, if the Fed believed it to persistently shift the rate of inflation rather than just the price level, under standard Taylor rule specifications, it would hike overnight rates by roughly 100 to 150 basis points. Whether the Fed decides to offset any price consequences from a weaker dollar will depend on whether it is concerned by so-called second-round effects that the initial move in currencies is leading to subsequent rounds of price hikes by firms. Second-round effects are highly dependent on economic context, meaning that if there are numerous other inflationary crosscurrents, they are likelier to occur. It will therefore be important for the Trump administration to carefully choose its moment for such a policy change or to coordinate currency policy with deflationary regulatory and energy policy. The disincentive for holding equities is somewhat mitigated, as earnings rise to offset some of the currency losses. A significant portion of sales made by S&P